The Market Zone is sponsored by E-Trade, the original place to invest online.
Welcome back. We have got just over 10 minutes left of trade, and we're now in the closing bell market zone, where we'll take you through everything an investor needs to know about the market day as we count down to the close. We'll track the most important stock moves and break down the market action as the bell rings.
You're going to see some of the biggest movers of the day constantly changing and updating on the right side of your screen. And CNBC senior markets commentator Mike Santoli will join us every day to break down these crucial moments of the trading day. Today, we've got Mark Tepper of Strategic Wealth Partners here to do this dance with us as well.
Well, let's kick off the market zone with Seema Modi, who's watching a bounce in the China market. Seema.
Hi, Wilfred. A number of Chinese tech stocks rebounding in today's session after the U.S. Treasury said it is not planning to block Chinese listings on U.S. exchanges, following a report on Friday that said this was under consideration by the White House, sending shares of Alibaba, Baidu, JD.com down 3 to 4%. Now, today's rebound, not enough to help the broader Chinese stock market, which did end the third quarter lower by 2.5%. Its seventh negative quarter in 8 as investors count down to the upcoming trade talks scheduled for October 10th. Guys?
Seema, thanks very much. Mike, the bounce in the likes of Alibaba, less than the fall on Friday, but this is an important story for the overall turn in sentiment that we got from Friday to Monday for the rest of the market.
For sure. We're bouncing in general, and they're participating in that bounce, but it does show you that at this story, even though there's been pushback on this story, it's sort of on the radar screen at this point of investors. They don't think it's going to go away unless it truly is discounted by the administration.
Apple is one of the big winners on the Dow today as we head into the close. Let's get to John Fort for those details. John.
Yeah, Apple, Morgan holding on to the boost it got today as JP Morgan raises its price target on the stock from a December 2019 $243 to a December 2020 $265. An iPhone is the reason. JPM says supplier checks show demand for the iPhone 11 is stronger than expected. JPM also bullish on the 5G iPhone many expect next year. They're raising their unit volume estimates by $1 million for the September quarter and $3 million for the December quarter. JPM saying, quote, "We believe the volume upside in 2019 will have significance in demonstrating that the firm can deliver balance of volume and profitability even in a tough backdrop." Now, a word of caution just from me. With the looming possibility of tariffs in December, it's possible that Apple is building more U.S. inventory than usual, guys.
John, key point right there. Thanks for bringing that to us. Mark, I mean, not only is Apple one of the best performers in the Dow so far for the quarter, but the semiconductor stocks, despite all of the angst around China over the last 3 months, have done pretty well, too.
Yeah, they have. And, especially as we move over to these new 5G phones, one of the semis that we own is Broadcom. So we like Broadcom. It's kind of our anti-semi, right? It's got more software exposure, more recurring revenue, but they're big in radio frequency, which is going to be important for those 5G phones.
Mike, 243 price target up to 265. Not a massive increase, but also pushing back the date for it from December 19 to 2020, which is worth factoring in as well.
Yeah, so about a 20% upside. It's, respectable at this point. What I find most interesting is it was a relatively tepid upgrade without a lot of edge to it, and yet the stock is up more than 2%, which just sort of shows people grab at Apple when they want a little more exposure to the market going into the end of the quarter.
Let's move on to GM. Suppliers are on the move as the UAW strike leads to layoffs at some of those companies. Phil LeBeau has the story for us. Phil.
Layoffs and rising costs, Wilf. We are in day 15 of the UAW strike at General Motors. The talks do continue today. This is the first day that strikers are eligible to get $250 per week strike pay from the union, not from General Motors, as they continue their protests and their strike at GM plants around the country. As you take a look at the suppliers, keep in mind there are growing concerns that as these guys have lost production, some analysts are saying they're not going to be able to make that up, and that's why you're looking at these stocks under pressure since the beginning of the strike. That's what we're looking at there in terms of General Motors, ticking slightly higher. It remains, generally speaking, where it was when the strike began 2 weeks ago. Guys, back to you.
Phil LeBeau, thank you. Mike, Is this going to be a gnarly earnings quarter for GM?
Yes, it's going to be noisy. In fact, if it goes much longer, I have a feeling we're going to be talking about some of the macroeconomic numbers, the manufacturing data. We're going to have to say, well, if you add back the effects of the UAW strike. So maybe it's going to just kind of cloud the picture just slightly. But I do think it's also a tricky spot in the auto cycle for them to be going through this, even though it's not, kind of make or break stakes at this point in terms of what's on the table with the union. It's obviously something that the market is just not sure what to make of.
All right, Thor Industries, meantime, is on pace for its best day in 8 years, and Frank Holland has more on that on the heels of those earnings. Frank.
RV maker Thor shares up more than 15% after solid outlook for next year and a beat on earnings, both largely due to strong sales of European RVs, better known as caravans, from the Erwin-Heimer Group. That's a German company Thor purchased back in February. However, the U.S. market is expected to decline for the third straight year after a record 2017, some tough comps there. Another RV maker, Winnebago, their shares also 6% higher today. I've spoken to CEOs of both of those companies. They believe the consumer economy is very strong, citing consumer spending increasing for the past 6 months. Back over to you.
Frank Holland, thanks very much for that. We've got just under 6 minutes left until the close. We are high by 135 points on the Dow, just off the session highs of about 170. If you're just joining us, you might notice your screen looks a little different from normal. We've launched the Market Zone here on Closing Bell, where we bring you uninterrupted coverage into and after the close. All the stories you need to know with constantly changing data on the right side of your screen. And at the bottom of your screen, you can see a preview of the next few stories we're covering to guide you through the close.
It's the new normal. As you mentioned, we got about 5 minutes left until the close. There are a lot of biotech stocks moving under the radar today. CNBC's Meg Terrell is bringing them to light. Meg.
Hey, Morgan. Well, a major cancer research conference over the weekend in Europe has several biotech and pharma stocks on the move. Seattle Genetics is among the leaders, with bigger companies Merck and Bristol Myers also gaining. On the flip side, G1 Therapeutics among the biggest laggards in the space after its updates at the conference. And outside of that, the biggest gainer among biotechs today is due to old-fashioned M&A. Dova Pharmaceuticals is being acquired by rare disease company Sobi, and a deal valued at as much as $915 million. That's sending that stock up almost 40%, guys. Back to you.
Meg, thanks very much. Mark, quick take on healthcare more broadly. What do you like?
Yeah, so within healthcare, we'd like to be in the medical devices, right? So that's where I think you're going to get more stable growth. So a company like Abbott Labs, that's a company that we really like. We own it. Abbott Labs, one of the great things they're doing right now is they're really at the forefront of solving this diabetes epidemic that's a result of years and years of these high-carb diets. So their Freestyle Libre glucose monitor up 70% year over year.
Let's move on to Bed Bath & Beyond, jumping after an upgrade. Courtney Reagan's got the story. Hey, Court.
Hey there, Wilf. So Wedbush upgrading Bed Bath & Beyond to outperform from neutral, also upping its price target to $16 a share from $14, just 2 days before the beleaguered retailer reports its quarterly results. Analyst Seth Basham says he sees, quote, a good chance of stabilization, if not growth, in earnings over the next 2 years as sweeping changes take hold. Bed Bath & Beyond does have a new board. It's seeking a new CEO. It's also cutting costs, reducing inventory, refreshing stores, and evaluating a number of non-core assets. So shares are higher by almost 8% on the report today. They're down 75% in 3 years. It's also key to note that short interest in this name is about 52% of float. Wilf?
Court, thank you very much. Let's go to Mike. Market breadth you're looking at the moment.
Yeah, New York Stock Exchange breadth, it's been positive all day, pretty solidly so, although it has kind of become a little more ragged right now. It's been less than 2 to 1 positive all day, and now it's even narrower than that. So I think you'd have to say we got a relatively mild bounce off of Friday's sell-off, and then most stocks are participating. Another way to look at breadth is the equal-weighted S&P 500. RSP is the ETF compared to the actual S&P 500. And what you're seeing now is, the outperformance over 2 days of the equal weight, which is something that's maintained today. It's about on parity right now. It shows you reasonably broad, but nothing overwhelming. Also, volume's pretty light today. Last day of the quarter notwithstanding.
Putting that in context for us, you're watching the Market Zone. We have less than 3 minutes to go here until the bell, which will end not only the session, but the month and the quarter. Let's send it over to Rick Santelli for a check on bonds. Rick.
Well, you know, we started out the day with the second worst number for Chicago PMI since the end of 2015. Now, as you look at a chart of 10-year for the last 5 weeks, 190 high, 146 low, the midpoint right about where we're closing, down a basis point on the day. If you look at 10s minus boons, you know, about a year ago, they were 260 basis points, 280. We've lost 50 basis points of rates bottom. Finally, the dollar index continues to surge, another fresh high going back 28 months. Bertha, the NASDAQ, the index with the best performance today percentage-wise. How does it look from your end?
Well, today, you know, we're seeing a lot of sort of the ugly ducklings today getting a bit of love. Some of the stocks that have not done so well this year. Newell today is one of the stars. It's up 3% on an upgrade from SunTrust, which says that they think that the company's turnaround is really starting to take hold. The stock is up about 21% for the quarter, but down 27% from its recent highs. Marriott, though, is one of the big losers on the quarter, down about 11%. Overall, this was a quarter where you saw chips come back despite swooning over tariff fears in August. They were the big leaders. Big cap tech up pretty well as well. Software flat on the month, and biotech was the big losers. We've gone from worrying about Congress doing something on drug prices to worrying about whether Elizabeth Warren's surge in the polls is going to mean Democrats are really going to move on bigger regulation. Finally, small caps this month have really done very well. They've been the leaders. Looks like they are still going to be down for the quarter, but overall, it's been a fairly good month for small caps. Bob, over to you.
Thank you, Bertha. Two sectors going in different directions here. Energy stocks moving down again today. We had China economic data that was a bit weaker, and we had concerns about a shortfall in oil. That's fading away here. This is the third energy rally that's failed this year. Earnings for exploration and production companies like EOG have been coming down fast. Elsewhere, better picture with retailers. Another strong day. Look at Chico's, L Brands, Foot Locker, all strong. Many up 10% or more this month. Still a horrible year. Close. The S&P 500 closing out the quarter up about 1%, closing out the month up about 2%.
If you're just joining us, welcome to the Closing Bell. I'm Wilfred Frost.
And I'm Morgan Brennan, and for Sarah Eisen, along with Mike Santoli, CNBC senior markets commentator. We are in the market zone. You can see the day's market action on the right side of your screen, where the story is still coming up on the tabs at the bottom of your screen. Let's take a look at how we closed the session here on Wall Street as stocks settle. Gains across the board, though, off the highs of the day, with the Dow finishing up about 101 points. The high had been 175. The S&P also finishing up about 15 points, or about 0.5%. The NASDAQ finishing up about 0.7%. And the small caps, the Russell 2000, finishing up 0.2%. Only two sectors in the red today, financials and energy.
Yeah, tech doing well. Healthcare materials leading the charge. Also worth noting, Morgan, the dollar up 0.3% today. A big move during the quarter. There is the quarter performance. This, of course, the end of the quarter move now, 3.4%. So for all of President Trump's comments about it, he does have a point if you're looking at that last 3 months. And, of course, with earnings season coming up, it will be something to keep an eye on.
Worth noting that all the major averages also finished the month higher. And the NASDAQ, the S&P, and the industrials also finished the quarter higher. One chart to show you right there, though, that was a different story would be the Renaissance IPO ETF, ticker IPO. You saw a gain today of about 1%, but in general for the quarter, it did finish lower. And that's because we've seen a lot of these big tech unicorn names that have gone public in recent months really sell off, especially recently. Even high-flying names like Beyond Meat finished the quarter down about 8%. Joining us to talk about the market day in general, though, is Mark Tepper, CEO of Strategic Wealth Partners, still with us, and Sam Stovall, CFRA Chief Investment Strategist. Welcome to you both. Mike Santoli, though, I'll start with you. On this first day of market zone, it would probably be accurate to say that the markets have been in a sideways zone, right?
They have largely been sideways, Morgan. As a matter of fact, you could hardly have more perfectly recouped Friday's loss than you did today. Last Thursday, the S&P closed at 29.77. We closed today at 29.77. So essentially today, you took back that sort of pre-weekend jittery, news-driven sell-off. I think that what you would say from September is that the market had plenty of excuses to back off harder than it did, and it really remained hovered within this area around within 3% of the all-time high. So I do think you can take away from that there's been some resilience on display.
For that reason, you're invoking a bit of Kelly Clarkson as well.
Well, yes. I mean, what doesn't kill you make you strong.
Makes us stronger.
So it could be a Clarkson rally, we got to say.
There we go. Mark, what's your take on these levels as we look at what's a strong month and a decent quarter? How are we set up for the final quarter of the year?
So, I mean, the fact that, just as Mike said, the fact that the S&P was up roughly 2% this month in the face of an impeachment inquiry, in the face of trade deals that are, escalating and de-escalating, and some disagreement within the Fed, I would think the market's been pretty resilient. I think we're setting up for a much better fourth quarter than a third quarter.
Sam Stovall, do you agree with that? I'm looking at the title of your most recent note. You say a case for Q-phoria. What do you mean?
Oh, well, what I mean is that there is the potential for euphoria to take place in the fourth quarter. As Mark had just mentioned, as Mike had just mentioned, that because we have had an awful lot of headwinds that we could have contended with negatively, the market still is about 0.5% away from an all-time high. And I think also when we look to what is likely to occur in terms of third quarter earnings reporting period, where we're down almost 4%, I like to say that you can rarely hurt yourself falling out of a basement window. So with the bar already set so low, possibly will end up surprising to the upside.
Well, one firm that disagrees with the view of a Q4 is Morgan Stanley. They've turned more bearish on the U.S. economy, stating in a new report that the risk of a recession has increased materially. The firm saying that they've moved, quote, from the perception that this is late cycle to a belief that it's the end of the cycle. Mike, they've been more bearish than some for a while. Yes. Is this a sort of chasing that view, doubling down more than seeing the fundamentals actually change?
I think there's at least a little bit of introspection and self-scrutiny in this and trying to say, look, have we been missing something here? They've been calling for a range-bound market with us being at the very top of the range they're calling for. I don't know that we've necessarily gotten the verdict on this yet. I mean, some leading indicators of recession are moving in that direction, but you have not seen things like unemployment claims turn up. You haven't seen the leading economic indicators turn down in a decisive way. So I think this is going to be the argument we're having for a long time right now is it just been a lull in growth and that essentially the Fed is going to cut 2 to 3 or 4 times without necessarily seeing a lot of pain up front? Or, are they potentially behind the curve and, in fact, recession is inevitable the longer the trade fight goes on?
Sam, there's a difference between markets and the economy, right? So how key is one to the other right now?
Well, I see that the economy is actually still relatively solid, to use the term that the Fed described a little while ago. I think most investors are optimistic in nature if they don't believe that a recession is around the corner. Bull markets don't die of old age, they die of fright, and what they are most afraid of is recession. And as Mike had just mentioned, while some indicators are weakening, a lot of people are pointing to the manufacturing indicators such as the Dallas PMI, the Chicago PMI, et cetera. We got to be reminded that about 10% of the U.S. economy is manufacturing based and 90% is services. And if we're still well in the expansionary readings for the ISM non-manufacturing category and other services-oriented readings, then I would have to take that positively.
It's the last day of the month and the quarter. Let's get over to Bob Pisani for the stocks that are leading us higher. Bob.
And this has been a very strange quarter overall. If you would have told me at the start of the month that everything that was up would be essentially defensive, I would have said you were crazy, given the move that we saw early in the year in cyclicals. Yet take a look here. What do you think of the market when you got a quarter where the leading sector is Treasury, 20-plus year Treasury is up 8%, and gold on top of that? Sectors in terms of equities, the leaders are utilities and consumer staples. Folks, look at this long and hard. You will not see a more defensive rally in a long, long time. Meantime, the laggards, Q3 essentially gave the thumbs down to global economic growth. All of the decliners were essentially tied to the cyclical sectors, metals and mining, energy, materials and banks, the lone exception being healthcare, a little more defensive. That had problems as biotech sold off late in the quarter, of course, on concerns about slower growth in that particular sector. Guys, back to you.
Bob, thanks very much. Mike, one other asset class to throw in for the quarter's performance, which I mentioned at the top, is the dollar.
Yeah.
Huge move for the broad dollar index, 3.4% for the quarter. To what extent will that start to weigh? Are there key levels on the DXY that if we cross over, it spooks equities more than just the gradual
I don't know
increase?
if it's going to be as simple as the round number 100, which doesn't really make a lot of sense because it's not in itself, I don't think, the ceiling for past rallies or anything like that. But it's been interesting. I don't think it's been a very linear relationship between strengthening the dollar and even types of stocks that are working right now. So perhaps just because it's been, at these levels within the last couple of years, it seems like it's not weighing except on earnings estimates, perhaps, and that's probably the place that we're going to see it.
Mark, the fact that the Russell 2000 and the transportation average both finished the quarter lower, they've been underperforming. How crucial are they to a more sustainable, broader market rally into the end of the year?
I would typically say that it's very crucial for the Russell 2000 to perform and to at least keep up with the S&P 500. But the research has been done that during long secular bull markets, towards the tail end of those bull markets, small caps underperform. And that's really just due to the fact that they have high leverage. A third of the companies aren't making any money. And then all the best small caps are now mid caps. The best mid caps are now large caps. So all the best companies have graduated, and you're left with companies that are of lesser quality.
Mark, Sam, we'll leave it there. Thank you both very much. Still to come, we are 1 month away from the Brexit deadline. And coming up, I'll sit down with the former UK Prime Minister David Cameron to talk about the chance of a deal and how he feels about the 2016 referendum now. Closing bell, back in 90 seconds.